Okay, so with all the crazy swings in the market lately, there's really only one question on everyone's mind. Is the party over? Or, hey, is this just getting started? We're going to cut right through all that noise today. Let's follow the money and see what's actually happening behind the scenes.
I mean, you can't escape it, right? The story you're hearing everywhere is that the bubble, yeah, it's finally burst. They're pointing to some weakness in a few of the biggest stocks and saying, see, the whole thing is about to come crashing down. And look, it's a scary idea, for sure. It's why it's all over the news.
But what if that's not the real story? There's another way to look at this, a much more, let's say, compelling one. What if this whole downturn isn't a collapse at all? What if it's just a shakeout? You know, something designed to scare you and me right out of the market. This argument says, forget the headlines. If you really want to know what's coming next, you have to follow the one thing that really matters, the money, the liquidity.
Okay, so to get a handle on where that money is flowing, we've got to start with the people who are turning the knobs. It's starting to look like there's a pretty coordinated game plan here between the big economic policymakers, and they all seem to be aiming for the exact same thing.
And the whole debate really boils down to this one idea, something called the natural interest rate. Now, you can just think of this as the perfect temperature for interest rates, the economy's sweet spot. Getting this right is absolutely crucial. And the funny thing is, right now there's a huge disagreement about which way it should be going. And this, right here, is where things get super interesting. You've got the policymakers on one side saying that all these productivity gains from AI are going to lower that natural rate. And, well, that gives them the perfect cover to start cutting interest rates. But then you have classic economic textbooks that say, wait a minute, that's completely backward. A booming, productive economy should easily handle higher rates. In fact, it should naturally lead to them. It's a total contradiction.
So what's the takeaway here? It's simple, really. Forget the academic debate for a second. The direction they're heading is already locked in. The goal is to get those interest rates down and just pump fuel into the economy. And that decision, it has massive, massive implications for where all this money is about to go.
Okay, so if that's the game plan, you might be asking, where's the cash to actually make it happen? Well, that brings us right to our next point, liquidity. And let me tell you, right now, there's an absolutely insane amount of cash just sitting on the sidelines, basically waiting for a green light.
And just to put a number on it, the US Treasury is sitting on a $900 billion cash reserve. That's not just a number on a screen, that is a literal war chest, a mountain of dry powder, just ready and waiting to be pushed into the system.
And this isn't some far-off idea. There's a clear timeline. First, in April, tax season is going to top up those reserves even more. Then the plan is to start injecting all that cash into the system starting in May. And the goal is pretty clear. Create really bullish, positive market conditions, to make it easier to get things done and keep the markets humming along.
All right, so let's pause for a second. If the plan is to cut rates and there's a tidal wave of cash about to hit, why does everything feel so shaky? Why is all we hear about an imminent collapse? It doesn't add up, right? So let's peel back that scary story and look at what the actual data is telling us.
Yeah, the story they're selling us is all about weakness across the board. They're taking a dip in a few, really big tech stocks and blowing it up into this huge market emergency. But is that really what's going on under the hood?
Because when you look at the data, it tells a totally different story. Take the equal weight S&P 500. Now remember, this one treats every company the same. It isn't dominated by a few tech giants. Well, that index, it's hitting all-time highs. And what about smaller and mid-sized companies, both in clear uptrends? And here's the real kicker, high-yield bonds. These are a great way to see how much risk people are willing to take on, and they've been rallying like crazy.
So what does all this mean? It's pretty clear. This isn't a collapse, it's a rotation. The money isn't vanishing into thin air. It's just moving, shifting from some of those big, maybe a little overheated tech names into the rest of the market, the small and mid-sized guys. And honestly, that's the sign of a healthy market, not a weak one.
And get this isn't just happening in the US, not even close. To really understand the sheer scale of what's going on, we have to look at the bigger, global picture, because another one of the world's biggest economies is getting ready to open the floodgates too.
So on top of that $900 billion we just talked about in the US, China is about to pump another $400 billion into its system. Add those two together, and you're looking at a global tsunami of cash. And all that money, it has to go somewhere.
Okay, let's just put all the pieces together for a second. You've got coordinated policy pushing for lower rates. You have huge cash injections coming from both the US and China. You have a healthy rotation happening in the market, not some big collapse. Oh, and by the way, corporate earnings are growing at a pretty solid 15%. I mean, when you lay it all out like that, the underlying picture starts to look, well, incredibly strong.
All right, so for our last point, let's take this same lens, this idea of ignoring the noise and following the money, and apply it to one of the most talked about, most volatile assets out there, Bitcoin. Because what's happened recently has created two totally different stories.
So on the one hand, you have all the major news headlines screaming that Bitcoin is expensive and warning everyone that the top is in. But then you look at the actual on-chain data, and you see something fascinating. The long-term players, the people who've been in this for a while, they didn't panic sell on that recent dip. No way. They did the opposite. They used it as a massive buying opportunity.
And that really leaves us with one last simple question. When the headlines are shouting one thing, but the so-called smart money is quietly doing the complete opposite, who are you going to follow? Are you going to listen to the noise, or are you going to follow the money?